Hello traders, and welcome to another lesson. In today's lesson, we'll be talking about the types of liquidity. So there are two types of liquidity known as the equal lows and equal highs, and then the trend line liquidity. Okay, let us begin. Now, from our previous video, we talked about our strategy, which is the SMC strategy. Now, following our strategy, price needs to mitigate an origin as it moves. So this one leads us to the type of liquidity that we know as equal lows. So let's begin. Equal lows in an uptrend. Suppose price is breaking structures to the upside. This is in an uptrend. This is the equal low liquidity, like that. Like that. This is what you know as the equal low liquidity. And then we have a break of structure that is there. That is the break of structure. Let me clone that. Now, as price is moving, price is supposed to mitigate an origin. So that is liquidity. We clone that. So that is so that is liquidity. As price is moving, price is supposed to mitigate an origin. Now, if price does not mitigate an origin, that means the order block has not been mitigated, so it leaves an order block behind. As price is moving, it mitigates an origin. As it's breaking structure, price is mitigating an origin. Now, if price moves and it does not mitigate this origin, and it's breaking structures, this is what we call as the equal low liquidity, because we have a high and the low here, high and low. So this is what we call as the equal low liquidity. Now, liquidity is basically the stop losses that is sitting here of retail traders. Now, as price is breaking structures, if it did not mitigate this origin, it will break structure and then create another origin here. Now, the origin that price creates at this level, this is what we call the inducement. This is an inducement level. It's a trap set for traders. Now, for us, the smart traders, we know that when price is breaking structures, it's supposed to mitigate an origin. And when this origin is not mitigated, do not enter at this order block, because that is what we call the liquidity. Price will always sweep the liquidity and tap into our order block, and then it will proceed to the upside. So this is what we call the equal low liquidity in a bullish scenario. Now let me go to the bearish scenario. In a bearish scenario, suppose price is breaking structures to the downside like that. So this is a break of structure. That is a break of structure. And then when price breaks a structure, it leaves, there's always an origin that causes that break of structure. So that is our order block. That is our order block. And then right there, that is what we call the equal high liquidity. So that is the liquidity. So that is liquidity. Yes, like that. Suppose price is breaking structures to the downside and then did not mitigate an origin, just like from the previous video. As we said, when price moves, it always mitigates an order block. So if price did not mitigate that order block and then it starts moving like that, so that is what we call the equal high liquidity. That means price will sweep this liquidity and tap into our origin, which caused this break of structure, and then now we'll have price breaking structures to the upside. Always look for liquidity before you take your entries. Otherwise, if you're not finding the liquidity, you might be the liquidity. So always when you're taking your entries, find your liquidity and your order block, and then price will always have to sweep liquidity to go and tap into the order block, which caused that break of structure. So that is what we call the equal high liquidity. Then let's move on to the trend line liquidity. So in a trend line liquidity, in a bullish scenario, suppose price is breaking structures to the upside like that. So we have price breaking structures to the upside. So that is the break of structure. That is the break of structure. And then suppose price did not mitigate that order block as it was moving up. So that is our order block. And then now you have price breaking structures to the upside. We now have price breaking structures to the upside. We now have price breaking structures to the upside. Like that. As long as price did not mitigate this order block when it was moving up, all these order blocks that price creates up here, all these order blocks that price creates when it's moving up, all these order blocks that price is creating, it's moving up, that is what we call the inducement. Inducement meaning the traps set for the SMC traders, because now traders will enter on this order block thinking this order block is no longer valid. However, that is just an inducement level, that is a liquidity. So do not enter at these order blocks that price creates, it's moving up, if it did not mitigate this order block, because that one will be liquidity. This is what we call the trend line liquidity. That is what we call the trend line liquidity, meaning price did not mitigate this order block as it was breaking structures to the upside. Therefore, these order blocks that price creates, they are just traps. Always wait for price to sweep this liquidity to come and tap into your order block and then continue pushing up. So this is a trend line liquidity in a bullish trend. That is trend line liquidity in a bullish trend, like that. Always wait for price to come back to this order block, because this is just inducement, traps set by market makers to try to trick traders into placing positions here. So when you place a position here and you put your stop loss just below that order block, price will come and take you out and then tap into the right origin and then continue upwards. Now let's move to the trend line liquidity in a bearish scenario. In a bearish scenario, suppose price is breaking structures. Price is breaking structures to the downside. And then we have price breaking structures to the downside. And then we have that is the order block. So suppose that is our order block. And then we have a break of structure. We clone that, another break of structure. Another break of structure. Like that. Suppose price is breaking structures to the upside, and then as it moves, it did not mitigate that order block which caused this break of structure. That means if price did not mitigate that order block as it was moving down, that means every break of structure that price breaks when moving here, this is just inducement, meaning traps set by the market makers to try to trick traders into placing positions there. So this is what we call a inducement level. As long as price did not mitigate that order block as it broke that first lower low, that means all these order blocks that price forms as it's moving down, this is what we call inducement. These are just traps set by the market makers to try to trick traders into taking positions here. When you take a position, price will come and sweep the liquidity that is sitting here. So you now become the liquidity. If you try to take a position, when price is breaking these structures, so that one becomes the liquidity. That one becomes the liquidity. As long as price did not mitigate that order block, as it was breaking structures to the upside, whatever order blocks price creates when moving down, that is what we call liquidity. That means if you try to enter there, price will sweep that liquidity to go and tap into the right order block and then continue breaking structures to the downside. Alright traders, that is all for this lesson. If you did get something out of this video, consider subscribing to the channel and give it a thumbs up and drop a comment in the comment section, and I'll see you in our next video. Happy trading.